Welcome to part three on the effect of current interest rates on multifamily and residential property investments with Eric Stewart and Shad Hammond. In this final edition of our three-part series, we will speak about how the interest rates are affecting supply chains, labor prices, and the various loan products. Enjoy the show.
We've experienced a healthy amount of supply chain issues on a lot of my assets. The difference has been made with the relationships that my larger management companies have established. We've seen it with appliances, we've seen it with building materials on our renovations. And one of the biggest areas that we've had an issue with is staffing, believe it or not. We can't find contractors. We can't get skilled labor contractors out to work on our properties. So those have been issues. We're starting to see it line out a little bit. It's not as much of an issue as it was 6 to 8 months ago, but it's still there. It's still happening.
We're definitely seeing that. I actually have a person doing, this is something else for our folks who want to jump in the investment landscape, might not have enough experience or the chutzpah to jump headfirst in. Renovation loans is something that the resi side can do, where you're allowed money to finance the home, but also finance the repairs. So if anybody's on a call, heard anything about 203K loans or construction loans, renovation loans. So what we're seeing is that we are having difficulty with reliable contractors or contractors that are reliable or good contractors, but they're just spread thin because of so many jobs. And people really want to hold on to good contractors and try to be, tight-lipped with who's working on what. But once the secret's out that guy is good and he shows up to work every day, everybody wants to use his services. So we are seeing that, but we're also seeing the cost of goods being so high, or, the price of lumber. And, you want to frame out a house and it costs double this year than it did last year. Right. So we're seeing a lot of folks that are complaining that, hey, man, this flip, I'm looking at the numbers, my return on investment ain't the same as what I initially thought it would be when I went to go to Lowe's and price out some of the stuff, or I went to the wood place down at the waterfront and price stuff up, or damn, this tile is running, it's killing me, $6 a square. Guys are starting to complain a lot about the resources that they would use in these purchases, and the price of renovation being a lot more expensive than it was within the last 18 months. They've seen a big jump. So you're talking about service. I can't get guys to service the home. I can't get a reliable plumber. I can't get a guy to do the recess lighting or on my piping. It costs thousands of dollars more than what I budgeted for. So you're getting, again, contractors and cost of service, cost of labor. Everything is more expensive because of that supply chain. Doesn't mean you shouldn't invest though.
With the onset of millennials wanting to be closer to the downtown areas and things like that, and not getting married and so on and so forth, or getting married later, and the baby boomers selling their homes and wanting to move more into the city areas or downsize into apartments, are you guys seeing more demand for single family homes or multifamily in the primary and secondary markets, not necessarily tertiary?
I will say that from the lending side, in regards to just buyer IQ, right? We're seeing IQ because of social media, rooms like this, agents and investors reaching back, sharing information with family and friends. We're seeing a heightened level of knowledge that our buyers come in with. And now we're starting to see more than ever people say, I'm done with renting, I want to purchase, right? And now they're not just saying that, but they want to purchase that first house, a multi, at least a duplex at the very least. So that I see a lot of that. Again, it doesn't mean that the supply is there for them, but we have never seen education as widespread or information as widespread as we see it now. And the buyer that walks into your office and wants to purchase something most likely is hip enough or savvy enough to know that there's an opportunity for passive income. Now, because of that information being so widespread now, it has affected the demand, right? Duplexes were at a higher frequency. And again, I'm licensed in so many states. I track this stuff. Were at a much higher frequency and much easier to obtain than they are now. It's just that simple, right? And they also were priced differently. But because of that demand, we're starting to see sellers say, you know, I know what you're doing here. I know what you're going to make after we close this transaction. So they're being more aggressive in regards to what they're asking for. We are seeing single family homes at lower price points. We're seeing buyers shopping in those price ranges, starting to see wins in abundance, because we're starting to see people pull back because of inflation, rising rates and things like that. We're seeing people pull back, and less competition means if you are still looking to purchase, you are going to see more wins. And so that's kind of what we're seeing in the market now. We're starting to see it's tough to get a multi, and it's tough to get that yield. But again, doesn't mean you shouldn't do it.
In reference to what we were speaking about earlier, as far as what type of jobs are going to be available to the public as the year closes out, what are your thoughts on using a portion of your units for affordable housing?
I think it's a masterful hat. How about you, E? What do you think?
Yeah, we carve out somewhere between 10 to 15% of a lot of our properties for subsidized housing. We participate in the VASH programs, the Veterans Assistance as well. And I can tell you that, just as an aside, if you do plan on participating in a VASH program or any kind of subsidized housing, you want to really dial in and lean into the HUD office. Know who you're working with and know what type of follow-up they have for their tenants. You don't want to get left holding the bag with a tenant that's problematic, that impacts the rest of your tenant base, that has a negative impact on their quality of life. You owe that to your overall tenant base to make sure that the folks you're putting in there enhance the community. And to something that you said earlier, Cedric, a clean, safe environment is what you want to provide to these people. So you definitely want to maintain that. If it's not consistent with the overall tenant base, then we wouldn't do it. But on a lot of my assets, we've got around 10 to 15% subsidized tenant base.
How are you guys advising your clients on the varying loan products due to the rise in interest rates?
We know that price points have been drastically affected, right? So we know that you might have been pre-approved for $300K. With the way these rates have gone up, might be 265, right? And so we're starting to see more Georgia Dream programs. We're starting to see more, since I do a lot of origination in the Mid-Atlantic area, we're starting to see more of a use in regards to DSHA, that's Delaware State's housing agency, financing agency. We're starting to see Pennsylvania financing PIFA, or we're starting to use a program called KFIT here in Pennsylvania a lot. We're starting to see New Jersey's program a lot. We're starting to see a lot more down payment assistance programs, right? Because we know people are hurting. People still want to do this, but now their price point has changed. So, they want to spend money in terms of maybe buying rates down. They're more open to do that. We're starting to see a lot of folks ask, though, a lot about lender credits or different down payment assistance programs that open up more options for them in terms of how they pay for the transaction. But also, is there any money laying around that can help them try to get back to where they were when rates were, in many's eyes, is historically low?
In our world, it's really important that when someone is taking a loan on that is short-term in nature, if you've got a bridge loan that's going to mature in anywhere from 12 to 36 months, I always ask my clients to make sure that they have a clear vision of forced appreciation. Forced appreciation. By that, I mean, keep it simple. and make sure you can throw money at the problem. When I say throw money at the problem, I mean renovate your way to the value that you need to hit to be able to refinance out of that loan. You're taking on a short-term maturity. You want to be able to renovate your way out of that loan, and don't wait for the market to come to you. Don't wait for rents to rise enough so that you think you can refi. That's a 2008 problem, right? We want to be able to throw money at this thing, keep it simple. We're not going to say we're going to start to build back utilities, or we're going to build a carport and raise rents that way. We're going to beef up collections and run the property better than the seller did. You can't bank on that right now. You've got to be able to force appreciation and build value that way rather than hope the market comes to you. That's my advice to my clients.
Yeah, you
Okay.
mentioned something, man, with the bridge loans for sure. Definitely I've noticed that a lot more places are offering them, and the products can be very profitable for our buyers and investors. One other thing is that on the residential side, we're starting to see an increase where people are using home equity credit again, right? We're starting to see HELOCs or home equity lines of credit or home equity loans, but we're starting to see that again because some people might already like, especially in the resi side, if they purchased, a year, 2 or 3 ago, they have those historically low interest rates. And we're starting to see some people say, hey, I don't want to do anything different to my mortgage. However, I do want to access my equity because property value has continued to go through the roof, as we all know. Equity is ridiculous. Home values are ridiculous now in a good way. So how do I access my equity to maybe make another purchase and do so without touching my first mortgage on the house? So we're starting to see big increase in home equity loans. We're starting to see the rates be a little bit more comparable. First time in a long time, we've seen adjustable rate mortgages being mentioned from the resi side, being mentioned with more confidence that it's not, a scheme per se, but it is a way to say, hey, look, jump in on this rate now. And the moment it starts to get a little funky, maybe you will be already able to refinance, in the next 12, 18 or 24 months before that rate gets a little funky. And so there's value there to go in at an adjustable rate for the first time in years. Why? Because fixed rates have been so low that you hadn't had the need to go with an adjustable rate because the fixed rates are already so low. Go something fixed, keep it for a while, set it and forget it. So we're now starting to see adjustable rate mortgages increase in frequency and being used. We're starting to see, home equity lending start to pop up. We're starting to see a lot of that. And there's still been some value in refinancing, even though these rates aren't as sexy as they used to be. When you start to look and say, well, I still have X, Y, and Z debt, and they have all sorts of varying interest rates, none lower than the rate that I'm going to get on my house. So maybe I consolidate all of that stuff, right? And have just one payment, that be my mortgage payment, right? Maybe I should access that equity, pay for some of those bills, or again, access that equity and make another purchase, or limit your debt, get your debt to income ready, and shine yourself up for that next purchase, right? So there's definitely a lot of different strategies that you can still use in a high interest rate market. You guys can see.
That's a great point. I didn't think about that. Don't upset that first mortgage rate that you have. You locked in that good 2.8% rate. You don't want to mess that up. That's a great point. Yeah. And then HELOC's the way to do it.
Daniel, did I see your hand?
For Shad and Eric, and it's really just a general question for the residential side. How would somebody get started in residential investing? And then for Eric, how would you recommend somebody get started with multifamily investing?
There are two ways to go about it, and from the commercial side, getting started in commercial typically is going to require a level of relative experience. That's what most of my lenders want to see. And so it's something that we talked about. We talk about a lot is getting started, and that a great way to do it is to start with that 1 to 4 space. Build up a solid portfolio in your backyard. Cut your teeth on those. I don't want to say smaller properties because they can be, millions of dollars, but that smaller unit count. where it's manageable and you really get that grassroots level of experience, and then branch out into 20 unit or 30 unit and what have you, and just grow your portfolio that way, or partner with somebody. A lot of my clients will partner together and buy, 50 unit, 100 unit assets, something like that. So you either build a team and go out there and take down those larger properties, or be a bigger fish in a smaller pond and work with Shad, and he can set you up with the right mortgage and get your debt piece in place to where you can grow that portfolio in your backyard. I mean, he's your biggest investor, guys. 85% probably and I'll let him tell you how much he can do, but 80% of the purchase price is a huge chunk of that capital stack. So to be able to work that out with him and get you started, I can't think of a better place.
If we're talking, new, just starting out in the landscape, you want to, develop or generate that passive income or leave something behind for the kids. It's a safer landscape, but it's not the only way. So we know that, you can pursue with that 1 to 4 units, but professionals like Eric offer different strategies. If you've been in the game for a little while, you're going to see less oversight. You're going to see less restriction. And if you are truly qualified, folks like Eric are going to help you get from A to B. And so when you're looking at lending from a 1 to 4 unit space, folks like myself can obviously tailor a program that works specifically for you, and oftentimes use other people's money doing, right? In terms of down payment assistance programs, grants, and things like that. There's always a way to try to custom a financial product that allows you to keep more of your money in your pocket and use it for lipstick on your property. So that's always been kind of my thing, is how can we tailor something for you where you can get what you want, but still have some value to be able to maybe purchase your next grab, or have some value to be able to revitalize the property that you're purchasing. So guys like me, are always trying to work our magic to make sure you guys win and win efficiently.
Thank you, Shad. Appreciate you both on that. Thank you.
Again, I've seen a lot of wins between that 150 to 250 range. We're starting to get contracts just coming in left and right, left and right, left and right. We're seeing sellers finally kind of get that they have to know their room, right? You got to know the room, got to read the room. And you can't come in way here, high in the 275, 280, where maybe, yeah, you could have got away with that a year or two ago. But, anybody shopping in that 150 to 250 range has a certain amount of credentials that you have to recognize and be considerate of. And so now we're starting to see with the shift, with rising inflation, rising rates, sellers are starting to understand they can't price gouge any longer. They have to be more reasonable and respectful of the kind of buyer that would buy this house. And so we're starting to see them now being a little bit more cognizant. We're starting to see sellers be, more willing to adult, right, and negotiate, which means more wins for you. So yeah, that price range, absolutely, we're starting to see a lot more wins because sellers are starting to be more cognizant of who they're selling that house. And that they can't be way, way, way up here because it just doesn't make sense. You can't afford that if that's where you're shopping. So yeah, I think you got some wins in abundance coming your way.
This has been a night that has been jam-packed full of valuable information. And I would like to thank Shad and Eric for coming tonight. Cedric, is there anything that you would like to share with everyone about what we have up in the upcoming meetings?
Absolutely. Next month, we'll have an asset manager here to discuss from a multifamily perspective what it takes to be an asset manager, managing one of these multifamily complexes that are out there and all the intricacies that will be there. And as I mentioned earlier, we will be having here pretty soon our guy Jerome Lewis to come on and speak to you from a marketing perspective about social media and the best way to put yourself forward. And come by every month, everyone. we have a lot of quality content for you guys coming up. So don't miss a month. You miss a month, you miss a lot.
Absolutely. Absolutely. I want to applaud everyone for coming out tonight because it shows that you understand that with the right building blocks, you can build the perfect foundation for your apartment investing career. Be safe and be awesome. Have a good night. Welcome to part 3 on the effect of current interest rates on multifamily and residential property investments with Eric Stewart and Shad Hammond. In this final edition of our 3-part series, Welcome to part 3 on the effect of current interest rates on multifamily and residential property investments with Eric Stewart and Shad Hammond. In this final edition of our 3-part series, we will speak about the interest rates. Welcome to part 3